Hey, this is Terrence Young with eFunder, and I want to thank you for coming back to our channel. Today, I want to talk to you about DSCR loans. And DSCR loans is debt service coverage ratio type loans, okay? Now, first, here at eFunder, what we do, we help real estate investors and business owners secure capital to be able to help you grow your business. So, today, we want to talk to you about these DSCR loans and why they're such a powerful tool to be put into your tool belt to help you grow your business. So let's say you're looking to expand, you need to do a cash out refinance. Maybe you're a real estate investor that likes to fix up properties, then refinance them to rent, right? So in order to do this, in order to maximize the amount that you can get, you want to make sure your DSCR ratios are in the right proportions, okay? So, what most lenders look for is a 1.25% debt service ratio. And what that means is the net income from your property should cover 100% of the mortgage plus another 25% over that. That's your reserves. Now, I want you to understand the difference between, when you're buying a personal home compared to dealing with a commercial property. And when I say commercial, it could be a 1 to 4 unit investment property, rental. It could be a true commercial. It could be multifamily, anything but an owner occupant type of property for residential use. Okay, so now here's the difference. Let's say you're going to buy a property for you to live in. Now, what's going to be required, of course, your credit needs to be there, but then they look at your debt service ratio. Okay, so how much income do you make off of your job, and your bills? Now, the biggest thing with DSCR loans, debt service coverage ratio loans, and I love them, is it's all based off of the income of the property. Totally opposite, right? So as long as you have a cash flowing property and you hit that ratio, you can maximize the LTV that you can get for that property. And here's what I mean, because one of the biggest mistakes that I see investors do, because a lot of times they don't take the time to consult with someone like me. It's just a quick 10-minute consultation on a strategy can make the difference in your business. And here's what I mean. So let's just say you got a buy, fix, and flip loan, right? A renovation loan. You renovate that property, and instead of selling it, you're just going to simply refinance it, do a cash out with that value add that you done did to the property, and then take those funds to go purchase something else. So you can keep doing it all over again, right? It's called the Burr method. But here's what happens. Once the property is complete, and if an investor does not understand debt service coverage ratio, DSCR, then they will put a renter into that property and it's too low. Okay, that's the mistake that investors make, because now when they go to the refinance and they expect to get, say the max is 75% or the max is 80% LTV, it's going to be based off of the debt service coverage ratio. So if that net income is not enough to cover the maximum LTV, yeah, you could possibly still get the loan, but the LTV is now going to be reduced, and it's going to be reduced to fit the 1.25% ratio. So that means you may end up getting a loan at, say, 60% LTV, 65% LTV, and it may or may not be enough to do what you wanted to do to move on to the next property. So by having an understanding of what a DSCR loan is, the power of it, And yes, we do provide them. Okay. So, with this type of a tool in your tool belt, you can go far. So, yeah. So, if you like what you hear, hit the like button, subscribe, go share this with somebody else that needs to learn the same thing. Also, in the description, there's a link if you want to set up a free consultation so we can talk about your deal. By all means, let's talk. I want to partner with you. I want to be that help person to help you succeed in your real estate career. All right. You all take care. Great seeing you again. And until next time.